Ladies and gentlemen, I request you to settle down, please, so we can begin the session on commodity. I would request Mr. Kalyana Raman, CMD Kalyan Jewellers, to present on the dais. Okay, we'll just begin the session. Allow me to introduce Mr. Sumesh Paraswarampuria, the Director, Business Development and Products, MCX, who is the moderator of the session. He heads 4 core teams at the MCX. 360 degrees understanding of the commodities market, which includes operational risk, market risk, credit risk, and regulatory risk. During his career spanning 13 years, he has worked with various organizations of repute such as Hindalco, Britannia, Ernst & Young, and Motilal Oswal. His deep insight on commodities markets and products has earned him respect in the industry cycles. He is invited to speak at various industry conferences to share his vast understanding of commodities. He is an MBA in Finance from the Wellington Institute of Management Studies, Mumbai. On that note, please welcome Mr. Suresh Paraswarampuria.
Good morning, ladies and gentlemen. Shri Ramesh Abhishek. Hello. Good morning, ladies and gentlemen. Shri Ramesh Abhishek, Chairman FMC, and my other panelists. At the very outset, I would like to congratulate Indian Merchant Chambers for organizing such a seminar with well-defined sessions to cover all the asset classes. We begin today's session with commodity markets session. India's development has always been linked to the markets and trading culture. However, the objectives of the profitable commodity trade were the same yesterday, are the same today, and will remain the same in times to come. No doubt, the way we trade has changed and improved over time. Commodities play a very important role in the Indian economy, and with our country being one of the world's leading, I would say, producer, consumer, exporter, importer, play a very crucial role in the commodities market. This commodities market has been gaining a lot of importance in the recent times, and to deliver the keynote address on commodities markets, we are here to have an honor to have Shri Ramesh Abhishek, the Chairman of Forward Market Commission, the regulator of commodity futures market in India. In his career spanning almost 30 years in the Indian Energy Service, he has held a series of challenging positions. As Chairman FMC, he has taken a number of proactive measures to improve the markets. Ladies and gentlemen, please put your hands together to welcome Shri Ramesh Abhishek.
A very good morning to all of you, ladies and gentlemen, distinguished members of the panel, delegates, ladies and gentlemen. At the outset, I would like to compliment Indian Merchants Chamber for organizing this seminar. It is indeed my pleasure today to share with you my thoughts on commodity markets and their regulation in India. As you know, commodity futures market has been growing rapidly over the last 10 years, since the year 2003. So today the country has 5 national level electronic commodity exchanges and 16 commodity specific regional exchanges. 113 commodities are traded in futures market, and out of which about 50 are actively traded. The market has made enormous progress in terms of technology, transparency and trading activity. Demutualized national commodity exchanges with best trading, clearing and settlement practices have changed the contours of commodity futures market in India and have been able to attract substantial liquidity in a relatively short span of time. Value of trade in this market has grown from 66,000 crore rupees in the year 2002-03 to 170 lakh crores in the just concluded financial year. The number of clients who trade in these exchanges is more than 14 lakhs. An effective and credible regulatory regime is a prerequisite, as we know, for development of any financial market, as it generates greater confidence in the integrity and transparency of the system among the stakeholders and encourages them to participate in the market. Commodity futures market, unlike other financial markets, touches the lives of almost all citizens of the country, either as producers or as consumers. Hence, effective regulation of the market attains greater significance to ensure proper price discovery in a transparent manner and to ensure that the future markets works in a transparent and fair manner. There are 3 tiers of regulation in futures market in commodities in India. The first is the Government of India, second is Forward Markets Commission, and third is the commodity exchanges. The goals are market integrity for preventing market manipulation, to ensure efficient and fair pricing, financial integrity for maintaining the financial soundness of the clearing associations and their member firms, and customer protection as future markets are complex and sophisticated and investors may not have the information and expertise required to protect themselves. The Commission has a very robust regulatory regime in place to ensure a well-regulated commodity futures market on par with that of the best practices in other markets. There have been no defaults in the market in the last 10 years. There is a stringent KYC requirement for client registration. Commission regulates the trading through imposition of various regulatory measures such as limit on open position to prevent overtrading, limit on daily price fluctuation to prevent abrupt upswing or downswing in prices, a robust margining system for risk management, including margins to control volatility modeled on value at risk computations, monitoring and surveillance, settlement guarantee funds and investor protection funds. The volatility in prices is controlled by varying the margins and closing out the contracts in extreme or emergent situations. Commission has taken various regulatory initiatives in the last couple of years to further improve market integrity and strengthen consumer protection. We succeeded in stopping the misuse of this market for transfer of profits and losses by misusing of client code modification facility and trading without uploading using unique client codes. Such transactions have come down by 99% in last 1.5 years. This has definitely improved the market integrity and the image of the market. Clients acting in concert have been a major source of market abuse for commodity markets for last several years. Last year, January, we revised the clubbing guidelines of open position of parties acting in concert by making the criteria very flexible, and since then there have been very effective use of these new guidelines by commodity exchanges to prevent cartels from misusing and manipulating these markets. Investor Protection Fund was also operationalized last year in all the commodity exchanges, and by now almost 80 crore rupees have been transferred to this fund by the exchanges, which was lying with them for some time. To reduce the instances of unauthorized trade and empower the client with information, now there is a system of sending email alerts and SMS alerts to all the clients by close of business every day by the exchanges. From 1st April, this is almost 100%, because we have imposed very stiff penalties for any trade for which SMS is not sent. This has become very important more in this market because there have been frequent complaints of unauthorized trade, and this we feel that this empowering of clients will go a long way in preempting such complaints. The Commission has also prescribed uniform KYC documents for trading in all the commodity exchanges. Now we are working with other regulators and Ministry of Finance to have a common KYC for all the markets. To ensure greater compliance with the regulations, the process of audit of members of the exchanges have also been streamlined. We have prescribed a comprehensive audit manual and compulsory audit of all the members. We have also laid down a code of conduct for the auditors themselves. The complaints of off-exchange trade, also called dabba trade, has been also quite common in this market as well as it is in other markets. Last 1.5 years, we have worked with the state police. We have done training programs, awareness programs in more than 10 states where such complaints are more rampant, and we have tried to inculcate in them the need as well as the knowledge to stop this off-exchange trade. But this is something that we will be doing much more in the coming weeks and months. We have also issued guidelines for regulating algorithmic trading in the exchanges, which actually came into effect from 1st April. This is necessary to protect the interests of investors in the commodity market and to promote its orderly development. One of the very important problems in this market has been that it was always accused that excessive speculation in the market is leading to high prices and inflation. Last year in June, we introduced what is called a staggered delivery system in the main agri exchange, NCDX. Under this system, the seller can indicate their delivery intentions on any day during the last 15 days of the contract, which is allocated to the buyers in a random manner. This system has already yielded good results in terms of reducing excessive speculation in the near month and showing a more mature trading pattern in the concerned commodity contracts. This has also led to greater liquidity in the far month contracts. Since implementation of this particular measure and also a number of other measures, as a matter of fact, price volatility has also been significantly reduced. There are, of course, a lot of other factors, fundamentals are there mainly, but there has been no major criticism of the futures market so far as the prices or inflation are concerned, and now people are aware that the prices are moving more in line with the fundamentals and not because of any possible manipulation in the futures market. We are also trying to get more and more transparency in the trading patterns, practices. Exchanges now display the members' data, the trading activity during life cycle of a contract, and every day they are displaying what was the percentage of proprietary and client trade and algo trade on their previous day. It is being displayed on their website every day. We have also prescribed base minimum capital requirements for the members of the exchanges, and no exposure is to be given by exchanges on this base minimum capital. These funds would be utilized for settlement of claims by the clients, etc. Besides these regulatory initiatives, the Commission also undertakes a number of development programs because the awareness of these markets is very limited still, particularly among farmers and other stakeholders, and also there is a need to build capacities among the stakeholders to properly utilize these markets. This Commission, in association with the national exchanges, reputed business schools, cooperative management institutes and universities, they conduct various awareness and capacity development programs. More than 3,000 such programs have been done in the last few years, and over 400 capacity development programs also have been done. One of the objectives of government while starting this market was to help the farmers know the transparently discovered price on the platform so that they can use this price information for better marketing, sowing and other decisions. We have a very ambitious scheme of disseminating these futures prices to the farmers. More than 1,800 price sticker boards have been installed in various parts of the country, mostly in the agriculture produce market committees, and also some other locations where farmer footfalls are high. This has definitely made a difference so far as price dissemination is concerned. Now we are working on more price dissemination effectively through SMS to farmers and other stakeholders. One of the challenges this market faces is that actually this market is only an adjunct of the physical commodity market, and if the physical commodity market doesn't function very well in a transparent manner, the impact is also felt in the futures market. This ecosystem of the commodity futures market, as you would know, are the warehousing, SARs, credit providers and financing. What we need is a very integrated development of warehousing facilities in the physical market, a sound negotiable warehousing receipt system, credit linkages, and a more market-friendly agriculture marketing scenario. All the barriers to free movement of goods by way of APMC laws and different tax structures in various states is also another bottleneck in creation of a national integrated physical market. Eventually, the growth and development of the futures market is inextricably linked to the integrated and well-developed spot markets in commodities. An integrated system of spot and futures will enhance the credibility of the price discovery process and in turn attract more participation in the futures market, particularly by hedgers. The government, of course, has taken a number of measures to improve the physical market in commodities. The Warehousing Regulatory Development Authority has been set up 3 years back to ensure orderly growth of warehousing infrastructure and develop a sound negotiable warehousing system. The Ministry of Agriculture had formulated some time back a model law for improving the APMCs, and 18 states have already adopted it, and we are hoping that a uniform goods and services tax regime in the country will help commodity move freely in the country and help in creation of an integrated national market. While physical deliveries are not the objective of the futures market, it is considered necessary to ensure proper alignment of the futures market with the physical market. The imperfections of the spot market, such as lack of homogeneity in quality of commodities, information asymmetry, and other factors, they affect the formation of uniformly acceptable spot and final settlement price. As a result, there have been significant deliveries on the commodity futures trading platform because of this lack of transparent price discovery in the spot market. Warehousing system in commodity futures market itself are quite well developed and transparent, but a number of issues are there on warehousing front also, and we are addressing them now. Participation of producers, consumers and others having exposure to physical commodity market need to increase considerably in the futures market so that it is effectively used for price risk management. Speculators take risk and provide liquidity, but for the market to serve its economic functions, it is essential that we have a very well-balanced market with significant participation of the physical market players. Therefore, Commission has been taking several measures to improve the participation of hedgers and potential hedgers in our markets, and this would continue to be one of the main priorities. To have a greater interaction with stakeholders and potential hedgers, we are having a series of consultations around the country now. Now for various commodity groups, we are talking to the value chain participants in the major areas of consumption or production in the country. One of the important developments that has taken place in the regulatory space in last 1 year has been the formation of an advisory committee by the government under Section 25 of the Forward Contract Regulation Act to advise the government and the Commission on various issues pertaining to futures market. This committee consists of representatives of stakeholders such as farmers, cooperatives, value chain participants, commodity exchanges experts, and regulators such as SEBI and WDRA. One of the things that people are waiting for in this market is amendment of the Forward Contract Regulation Act, because the regulatory system has to cope with rapidly changing domestic and global environment. While the market has grown significantly, regulatory framework needs urgent overhauling to meet the challenges of the fast-growing market. Some of the areas requiring attention are updating statutory provisions, restructuring and strengthening the Commission itself, and setting up systems of adjudication and investigation for ensuring market and financial integrity. Once the amendment to the FCRA Act are passed by the Parliament, it will put in place the requisite statutory provisions for ensuring more effective regulation and development of these markets. The amendment of FCRA will also lead to more focused regulation, development of appropriate intermediaries like aggregators, commodity portfolio managers, commodity collective investment schemes, institutional participation in the commodity futures market. Improved intermediation will change the quality and value of the market. It can even be explored whether multinational commodity traders can be attracted to deal on our exchanges, which in turn will help our producers to get prices on par with the international prices. This amendment would also enable introduction of various products such as options and indices. The participation of banks, financial institutions, etc. will also be facilitated by the FCRA amendment. These would considerably increase the depth and breadth of the market. Institutional participation and banks' participation is very critical for future growth of this market. Banks can hedge against the commodity loans given by them or encourage their borrowers to hedge on this market, and may even consider giving a haircut on margins, interest rates if hedged on the market. This will encourage more hedging and market functioning will become more meaningful. As hedges increase, market movements will converge better into fundamentals of the market. And as the markets behave in sync with fundamentals, institutional participation will come forth, improving the volumes in the market, and then futures market will truly serve its economic function in a much more effective manner. Forums like today's is going to encourage very valuable deliberations which will serve as important inputs for policy makers. I look forward to new perspectives, new ideas, suggestions coming from this conference, and we are hoping that we'll all benefit from your thoughts and ideas. I wish you all success. Thank you.
Thank you, sir, for your valuable insights. In our panel discussion today, we will try to cover all the commodity verticals. There is precious metal, energy, the agri vertical, and finally the base metal segment. The first panelist that we have is from the agri vertical, and Mr. Somnath Chatterjee. He is head of procurement and logistics for ITC Food Division, where he has implemented best-in-class procurement practices for the new FMCG business in ITC. He has over 22 years of rich experience in handling key positions at food industry and FMCG segments. Mr. Chatterjee will throw some lights today on the global factors like the weather, the supply constraints which are impacting the price volatility in the agribusiness, the government policies and its impact on the prices, and finally, the key structural drivers which are influencing the agri-commodity prices is what he will try to cover in this discussion. Mr. Chatterjee, over to you.
Hello. Am I audible at the back? Yeah, thank you. Good morning. What I'm here to talk about today is agri-commodities. It's something which impacts Aam Aadmi and indeed all of us here in this room. I'm here to talk about atta, chini, tel. Okay. It's mundane, but it's very important and fast emerging as one of the most investable asset classes today in the world. Now, as a practitioner in this market, I'm often asked to give price predictions, and I'll get right down to it straight away without wasting much time. When I'm asked how are the prices of these commodities going to behave, I have a very common refrain. Being of Amir Khan's generation, I turn around and say, "Papa कहते हैं हर agri commodity का दाम बढ़ेगा." Okay, but on a serious note, it is true that in the long term, we are seeing finite land availability. We are witnessing massive population growth, number of mouths to feed. We are witnessing a water crunch. We are witnessing a scenario where input costs for all agri commodities, be it labor, be it the cost of diesel, be it the cost of fertilizers, everything has been going up structurally year after year. Added to that, government policies has always been there to aid the farmer. So in that great belief of the government, we've seen them increasing minimum support prices for all these commodities year on year. Now we can argue both ways about it, good and bad, but as people who deal in commodities, we have to accept this as a fact, and this is what's going to happen going forward as well. So structurally, all of these commodities are going to be bullish. To give you a little bit of a perspective on the medium term and the short term, we have to take into consideration that we are today living in a very globalized world. So supply and demand of these commodities in India itself is not enough. We have to look a little more of a macro picture. I'll just give you some interesting tidbits to think about. Did you know that all of these food commodities that I spoke about, that is wheat, sugar, corn, maize, soya bean, all of this can actually be converted into a fuel. So from the starch-based crops like corn, sugarcane, etc., we can make ethanol. Indeed, Brazil makes a lot of ethanol. And whenever the prices of sugar are not good, those guys switch to making ethanol and drive their vehicles with that. And all the other vegetable oils like soya bean, palm, etc. can all be converted into biodiesel. Now the interesting point is that if all food grains of the world, which is produced in one full year, all food grains including the starch grains and the oil grains, everything is converted to biofuels, we will only cover less than 5% of our petroleum crude requirement. Yeah? What is amazing today, and very few people, I don't know how many of you have actually noticed, is that in the wholesale market, in wholesale, palm oil and soybean oil today is at a price which is lower than what you would pay for petrol in your local pump. Yeah? Something to think about. And if more and more of these foods actually get converted to fuel, we have a problem in our hands. That's why I always say that petroleum crude rules and Reliance rules. My colleague next to me will be the real person who will give you the perspective, because every commodity that I handle is linked to petroleum crude. We must also appreciate that over the last few years, hedge funds and commodity funds have been pumping billions of dollars into these commodities. It's ironic that someone in a back office in New York, who has probably never even seen how coffee is grown or who's never seen a sugar cane in his life, is actually manipulating millions of tons worth of the market. This money can also be, it's not a very sticky kind of money, so this money can fly. So we got to be very careful. And when computerized selling starts happening, these commodities can, in the international markets, start falling like 9 pence. So we got to be aware of that. Coming on to specifics of what our outlook is for wheat, sugar, oil, maize, etc. I'd like to just share here with this forum that 2012 calendar year was an amazing year for agri-commodities. It was quite a frightening year where across the globe we saw a phenomena of drought hitting Australia. We saw drought happening in Ukraine and the Black Sea region. We saw severe droughts in North America and South America. In fact, in North America, for the first time in recorded history, some 50 people actually died of heat stroke. I mean, not heard of. Entire tracts of land with corn and soybean had been decimated in the US. As a result, massive shortage of wheat, corn and soya across the world. India was blessed. Despite having a delayed and erratic monsoon last year, we managed to salvage our sugarcane crop. We had already got in a very record wheat crop by the time the monsoon had failed. So we were sitting on very good buffer stocks of wheat, as probably you would have read in the press. You would have seen images of wheat rotting in open storages, etc. So on the wheat and rice front, we were very comfortable. And indeed, we emerged in 2012 as the leading exporter of rice in the world. Two things helped us in achieving this export target. One was, of course, the very weak rupee. I don't know how many of you would remember, but sometime in the first quarter of 2012, when I'm saying first quarter, I mean the calendar year, Jan, Feb, March, we saw the Indian rupee trading at around 49 to the dollar. And sometime during August of 2012, it had tanked all the way to 57. Now this made exports of anything out of India very attractive, and primarily when there is such a deficit of agri-commodities, when there is no wheat outside, when there is no corn and soya, everything was flying out. So that was one kind of a reaction we saw here. Led by this massive shortage and very high prices across the world, there has been what we call in our language a supply side reaction, so that everyone and his uncle has gone and planted all the crops that they could have. As a result, going forward into 2013, the likely scenario which is going to emerge is that the world is going to produce bumper crops, and I mean here the caveat is that weather should hold. Weather can play it around all the time or any time. But all things remaining equal, and the way meteorology looks like right now, bumper crops of soybean, wheat, and of course corn coming up in short order. Clearly, the prognosis for these commodities in the next 6 months, in the medium term, is very bearish. Interestingly, the only thing which is a little contrarian is sugar. So, while in the last 3 years the world has seen a bit of a excess of sugar, last year's drought and the continued impact, and many of you are from Maharashtra, are already witnessing that impact of the dryness and the drought in parts of Maharashtra, North Karnataka, AP and Tamil Nadu. we will see a drop in sugar production. That is our estimate. And next year, that is the sugar year which starts from September 2013, will probably see a deficit. I'm saying contrarian because the indexes are pointing at anything but a bullish sugar. Today, sugar as a commodity is languishing. It is at multi-week lows, and nobody is picking up the commodity. But this is the only commodity which, going forward, our outlook is that it might have some, it might see some fillip. There might be some bullishness. Otherwise, wheat, by late May, early June, the Black Sea wheat will be out in the market. Already, the wheat prices internationally, which were at $350 plus, and the government of India delayed the export decision. Today, that has crashed to 265, and the prognosis going ahead is as low as 225, 230. So we have really almost lost our export window. There is a lot of grain in this country already, which is carry forward from the previous year's stocks. And this year, we are probably looking at 100 million tons of crop. Major wheat crop coming up, which is going to be harvested. In fact, it's being harvested as we speak. So, going forward, it's going to be quite bearish for the commodity. But what was interesting about wheat, and I'd just like to touch upon this one policy aspect, is that last year, despite having, the government has something called an intervention stock, a buffer stock of all grains which has got to keep, right? Now, the stock which is held by the government for wheat last year was 4 times of that number, into 4. But despite that, they were hesitant in releasing the stocks into the market, open market, and therefore, despite having last year a wheat crop which was 4% higher, the prices in the domestic market went up 28%. Okay? This year we might see a bit of a reversal of that, and we see a moderated outlook for wheat. With that, I'd like to close. Time is short. I'd be happy to take questions and answer them over a coffee. Not on this panel because we are very short of time. Thank you very much.
Thank you, Mr. Chatterjee. Truly, the agri dynamics are really complex, and hence one's required to have different strategies, like using hedging, using futures contract, buying according to the fixed price contracts, contract farming, to ensure that sufficient quantities are procured at absorbable price levels. Now, the next panelist, what we have is on the bullion segment, and we have Mr. Kalyan Raman, Chairman and Managing Director of Kalyan Jewellers, who set up this firm in 1993, which is a 2 decades and has become one of the India's most trusted jewelry retail company. I would like him to cover, that what is the, in his organization, it has created a lot of transparency in the market, that how, value addition has to be done, and what are the costs that is to be recovered from the market. He's created a lot of transparency in the market, so I would like him to draw this point over here and request him to give insights on the current pricing and its impact on demand in the market, and also the factors which are influencing the gold prices going forward. So please, I request Mr. Kalyan, please present his paper.
Good morning, my dear brothers and sisters. We are in business field for the past 110 years. And in 1972, I joined my family business after my graduation. But during these times, I was doing share business as a part of my job, as a part-time job. So I am very glad now that I had an opportunity to walk through that Dalal Street and enter into this BSE. In 1993, I diversified my business to jewelry. But I was in a dilemma, and I was very anxious. What business I have to start? One day, while I was sleeping, I remembered the words of my grandfather. I still remember the words he told. I asked him, why you are always buying gold whenever you are getting money? He told in Malayalam, Swarnavum Bhumiyum Chadikilya. That means, gold and land will not cheat anybody. So that word pricked me in my mind, and that was the main reason why I thought of starting a jewelry business. For that I took 5 to 6 months. I studied about the market. I traveled several places, and at last in 1993 I started a jewelry business in a small town in Trichur, Kerala. From that time onwards, I can see the demand of the gold is increasing every year. You can see even during the global crisis in 2008, nothing has happened to gold market. The demand of the gold was still going on that time. And the countries who has kept gold as a reserve fund has survived. Now the big question is, why people are buying gold? Of course, it is a good investment. Sentimental reason also is there. Historically, traditionally, people are wearing gold ornaments, enjoying themselves, getting good satisfaction, and still that sentimental value is continuing. Again, it's a fashionable product. Now, especially the teenagers, not only the teenagers, middle-aged group, even old people, they are much interested in wearing gold ornaments, and nobody can stop it. Our Honorable Indian Chamber of Commerce President here told, buy, instead of gold, buy gold bonds as paper. Is it possible to wear a gold paper to enjoy as a gold ornament? Impossible. And our Honorable Chairman SEBI told, he rightly pointed out, no, the government should not stop investing the gold, should not stop anything regarding the investment of the gold. Now the industry has experienced big change. Customers are knowledgeable, choosy, and should give value for what they pay. That's most important. People are expecting more and more. So we changed our system. We changed our policy. We started to open big shops, say about 10,000 to 15,000 square feet area, keeping plenty of stocks, plenty of varieties, plenty of designs, and car parking facility. We provided the car parking facility, and we gave importance to the quality also. Now, trust and transparency plays a most important thing. So, we have started keeping 100% BIS 916 quality. That is Bureau of Indian Standard Quality 916. And we brought the transparency, that like MRP price. We adopted the system of MRP price. Nobody has adopted the system of MRP price in gold jewelry. we adopted the system of MRP price. In each and every ornament, we fixed the rate tag where it is very clearly mentioned at the percentage of making jar at what rate we are selling, so that the customer can compare our price with that of the other shop. And we, from the long time onwards, we adopted the system, less margin, more turnover. That still we continue. So automatically, the customer believed us. And the customer service also is most important. Till this time, we forced a fundamental change in the way business was done. So far the customers, we approached the customers. Now we started approaching the customers. So far the customers are coming to our shop. Now we started approaching the customers. For that we opened 360 consumer stores in the rural areas where we can teach the customers, and we adopted fight against impure gold. We never told any customer buy from our shop. We told fight against impure gold, buy only BIS 916 quality. Not a single customer should be cheated. That is our principle. Customers should not be cheated. We should give the value for money to them. So we spend lot of money for advertisement also, fight against impure gold. So we adopted the buy only BIS 916 quality. This customer service, we under the name and style of My Kalyan. So if a customer pronounce, he will pronounce My Kalyan. So he will think in his mind that it is his Kalyan, not my Kalyan, our Kalyan. Advertisement also plays a most important role in the business. But it should be 100% honest advertisement. We should not diversify the people by publishing wrong way of advertisement. It should be trustworthy advertisement. That also we place a most important advertisement. Also we are doing 100% honest advertisement only. Now regarding the future of the gold. As I told before, investment. Gold is a very good investment. The people cannot invest their money in real estate, because if they want to invest in money, they have to spend huge money. And if they deposit in the bank, they will get only 8 to 9% interest. Again, if they are investing in share market, nowadays the share market is very fluctuating, and they will get tension also. So if they invest in gold, it is very safe. For one shoot, they will get two benefit. They can invest in money, they can enjoy wearing the ornaments also. Even the gents are also enjoying wearing the ornaments. And nowadays, the mining centers, no new mining centers are discovered so far. And the existing mining centers, especially in South Africa, year by year it is going deeper, and the cost of production is going up. If the If the rate is below $1,400 per ounce, they will stop their production and supply. So the demand again goes there. So the time is over. That's why I got the list. Because anyway, I will sum up the matter. At present, we have got about 48 showrooms, and each district, in almost all districts in 6 states, we have got showrooms. Recently, we opened 3 showrooms in Mumbai, and as per my knowledge and belief, the trend for gold and the demand for the gold will increase only, and nobody can stop it. And my request to the government is, better not to try to stop the gold business. Because, see, It is a right of freedom. The fundamental right. Anybody can do any type of business, honest business. That the government should see. And again, see ordinary customer, ordinary people, labor class, whatever they are getting daily, they will keep it separately, and whenever they are getting 50,000 or 60,000 rupees, they will go to the honest shop and buy gold ornaments, and they will keep safely. For that, if the government, if they bring the KYC and all, they don't know, the ordinary people don't know what is PAN card. They don't know the PAN card. So it is difficult, it will affect the common people only. They will be forced to go to unregistered firms. There is no safety, no guarantee for the gold, and it is difficult for them to insure the gold also. Again, where the people will invest their money? Government is not giving any other alternative. And the government, see, you can see, they have increased the customs duty, 6% customs duty. What happened? Smuggling has started like before. So, the government state government is losing their revenue as sale tax, and the central government losing revenue from way of income tax. So, my time is over. I have taken a little bit extra time. Extremely sorry. Thank you. Thank you.
Thank you, Mr. Raman. Our next panel is on energy vertical, and we have Mr. Savos, the head of Global Trading Reliance Industries Limited, who leads the team responsible for buying crude oil and liquefied natural gas, selling refined products, as well as shipping and price risk management activities for Jamnagar Supersite Refinery. What I would request him to cover and keep his presentation little brief, because we have a time limitation. So I would request you to cover, and present the global oil and petroleum outlook. You can also touch upon something on the evolution of energy demand, the changes witnessed in demand supply, the price history, and the factors that will play out going forward. But again, I request that to keep it brief, because we have certain time limitations. Over to you.
Thank you. Good morning. Firstly, I wanted to thank Somesh as the moderator, and also the Indian Merchant Chamber for the opportunity to represent Reliance and give you a view on the energy outlook. One small personal reflection. The keynote speaker this morning was talking about the growth and the energy and the opportunity for India. For me, as a British citizen who's recently come here, I can resonate with that. I mean, if I look at what's happening in Europe, the economic situation there, it's a very big contrast to the energy, the opportunity, and everything that's going on in India and in Asia more broadly. So I think I share all of the reflections from this morning. Just some legal background. My role here isn't to give you an overview on whether I'm advising you to buy or sell oil. I'm here to give you a view on what's going on in the energy market. Looking forward out to 2020, the developing world accounts for 85% of all of the growth in the world's energy demand, led by China, led by India, both of whom are seeing on average 7 to 8% growth in GDP, across the rest of Asia, Sub-Saharan Africa, Latin and South America. In contrast to the US, which is still seeing a regrowth in the economy, but at much lower levels, and very much in contrast to Europe, which is going through a period of stagnation, and through Japan, where many people describe the lost decade of recession. One of the things, though, that comes with rapid economic growth is inefficiency. And you can see that if you look at the second graph, the middle one, it shows the energy intensity. So it's basically how many barrels of oil per GDP unit do you need to produce your energy. And what you'll see is India and China are big consumers today, but out to 2020 there will be big changes which will make them more and more efficient. So even though you're using, in the region we're using more and more oil, we will find ways of using it in a better way and more economic way. Where that gets you to is a place where energy becomes less of a variable in how you grow. So if you look in the EU and in the US, even during the economic recession in 2008, the energy demand didn't really grow, didn't really move, even though the GDP stagnated. And similarly, during the period of growth, 2003, 2007, the energy demand didn't really move. So that's the high-level macroeconomics. If you now say, what does that mean for global energy demand? So energy demand will grow by 20% globally. Remember we said Asia the developing world will account for 85% of that. Oil continues to play the biggest part. Even with the emergence of biofuels and other renewables, even with a move into nuclear by many countries in terms of getting energy security, oil continues to be the dominant commodity, particularly for the transport sector. Most of the incremental energy that's needed in the future is needed for power generation, for electricity. That represents about 40% of the increase going out to 2020, which is why coal remains so big, particularly in places like China, which has huge reserves of coal, and also places like the US. Gas is becoming more important, particularly in places in the US, where the recent discoveries over the last decade of shale oil and shale gas have caused a resurgence in the US economy. China has shale, probably reserves equivalent to the US, but it's more difficult in nature to access, but it's not clear when that will come on. And similarly, the recent emergence and production from in India and from our company in terms of the gas that's here. Biomass, nuclear, hydro, others still remain an important part, but because they come from a low level, even though they grow, it doesn't really change things very much. If we then come down a next level into what does that mean for liquid fuels, so for the things we use for transport. Liquid fuel demand grows by 10 million barrels out to 2020, again driven by the developing world. So if you notice, of the 10 million barrels, actually the developing world grows by 11.4. And the developed world comes off, and you get some substitution caused by LNG coming in the US. Of the growth, crude oil remains, so you go from 90 to 99 million barrels a day. Crude oil is 4 million of that. NGLs, particularly in the US, is the other part of that. Biofuels, gas to liquids, coal to liquids play a part, but only a very small part. So what could happen? Crude oil is the kind of benchmark for the industry. Crude oil, we're at interesting times, I think. So, unconventionals, no one expected the US to produce an extra 800,000 barrels a day, which is what they produced in 2012. It was the biggest year of an annual increase in US domestic production for the last 50 years. It moves the US more closely to a energy security and energy independence situation, which they've been striving for a period of time, and looks as if it will continue. Unconventionals also have, and shale gas also has potential in other parts of the world. I mentioned China. Europe also has opportunities, South America. And it's now coming in contrast to 4 or 5 years ago when people were believing in a theory called peak oil, which is the world would run out of oil and we'd already found the maximum of what we were going to produce. We continue to find more oil in unusual places, be that unconventional, be that deep water, and there's probably more conventional onshore oil. In terms of where the growth is coming, Brazil is Iraq is the biggest single change, plus shale oil, then Brazil, and then Canada. And those things could add material amounts of supply onto the market. So what does that mean then in a world where you're producing more and more of the raw material and it's competing for customers? So potentially, if you say you've got 10 million barrels of extra demand going out to 2020, 4.3 of that comes from non-OPEC, 4.2 comes from NGLs, a little bit from bio. The interesting fact is it says of the 10 million incremental demand, what's actually required from OPEC is only 0.2. So we don't really need any more oil from OPEC. Now OPEC have a different view, which is they have a low cost of production, they can produce more oil, and they will produce. So, their plans for additional capacity growth in the same period of time are another 3 to 4 million barrels a day. So we're going to be in interesting times going forwards where there are going to be competing producers wanting to place the same barrels of energy with consumers, with refiners, with other transport fuels. And it's going to be one of the things that could make the market more volatile and could make it difficult to determine what's going to happen. Is you now have more and more surplus capacity, potentially with OPEC being able to have a less controlling factor and a less of a dampening factor that they have in the past to be able to hold the oil price. So if we come to the oil price, the oil price is currently stuck in a relatively narrow range relative to recent history, and about the 105 to 120 barrel a day range. Just if you look back, oil is one of the most volatile commodities that there is on the planet. Relatively small changes in global situations can cause big moves. So the increase from 2007 to 2009, and when we went from 16, if you go back even further to 2004, you actually went all the way from 40 up to 147, was probably only driven by an incremental 2 or 3 million barrels a day of demand. 2 or 3% extra demand caused a 600% increase in price. Similarly, you saw what happened after the global economic crisis and the very rapid, immediate correction in the oil price. So actually, in relative terms, we're going through a period of stability at the moment. So, what are some of the things that are going to play out going forwards? What could cause the oil price to go up or down? On the positive side, there are signs of, certainly in Asia, economic growth remains strong. In South America, it's strong. Even the US is starting to turn around. So continued growth from those areas will continue to pull on demand. Geopolitical factors and uncertainty, be that Iranian sanctions, be it North Korea, always factor in. Oil is one of the things that always reacts to political events and geopolitical events quite quickly. Iraq may not be able to, you saw the aims of Iraq to bring a lot of oil on very quickly. It remains to be seen whether that will be possible, whether there will be delays to that. And there continues to be environmental concerns, be that over shale gas or be that over tar sands in Canada. And we're going through another period of cost inflation. It's becoming more and more expensive to drill and explore and find oil. On the bearish side, things that could bring it down, as I say, no one expected 800,000 barrels a day increase from the US last year. That could continue. We're only really at the start of the shale revolution, many predict. So that could be a bearish factor and lower the oil price. And similarly, the Iraqi oil coming to the market will make it harder for OPEC to hold, as we said. High prices also change consumer behaviors. So in Europe and in the US, when you saw petrol and diesel prices go very high, people either stopped driving so much or they bought smaller cars which are more fuel efficient. So you'll see a gradual reduction in fuel demand as well as fuel efficiency takes place. and natural gas liquids has the potential to be a transport fuel. In the US, you already see natural gas liquids being used in big rig Mack trucks. Canadian Railways are looking to convert a number of their fleet onto using LNG because it's freely available and very cheap. So, in summary, for the moment, things look to be range-bound. There are a number of big macro events that could play out over the short to medium term, which, if you go back and look at the history of the oil price, could be very volatile going forwards. So, thank you.
Thank you very much. Indeed, we need to have a pragmatic approach to tide over the challenges faced by the petroleum and oil industry. It makes a strong case for us, therefore, to have a strong price risk management practiced by the industry. Now the next speaker is on base metals. I would request Sandeep Daga to give his views on the base metal segment. When we talk about base metals, the year 2012 had been a mixed year for base metals, where we have seen a lot of volatility. The international prices and the rupee-dollar movement, we have seen extreme sides happening, and because of that, lot of companies, had suffered a lot of losses also. So, what is that they require to do and tackle these volatile times? Whether they require to get into a risk management framework? Okay, is the Chinese super cycle over in 2012? Is certain questions which we require to address. So, I would request Sandeep Daga to present his view. Sandeep is an old friend of mine. Currently the founder and director of Regis Consulting Private Limited. He is a risk management professional who specializes in commodities. Sandeep Daga, over to you. Thank you.
Thanks, Somesh. Good morning, everyone. I shall keep my speech in two parts, looking at the big picture of base metals first, and then key themes for 2013. Between 2002 and 2012, we saw nearly a decade of bull market in base metal prices, led by China. Data suggests that about 90% of world's incremental demand for metals was created by this single country. Therefore, there is no doubt that China has been the god of base metals demand. This is why a good part of my discussion would be around this country. In my last year's presentation at the same forum, I highlighted Chinese upcoming slowdown as a key theme. The slowdown is quite apparent now. At this juncture, let's look back and analyze whether the Chinese metal-intensive growth is over. Is the story over? Whether China has done too much in the last 10 years, or too fast, or maybe both. There is no doubt that Chinese pace of growth has been amazing, much faster than Europe in 1800s, or US in 1900s, or maybe Japan in 1950s to 80s. Cash generated by record trade surpluses and high domestic savings were put in use by the country in creating infrastructure. So, they created new cities out of barren land, 10 to 20 of them every year. One of the fastest rapid rail systems that can put the Western world to shame. World's most advanced subways, waterways, ports, airports, these helped creating demand for metals. However, all of these happened too fast, much, much faster than Chinese could afford them, and therefore had implications. All of us have heard of ghost cities in China, which are beautifully designed and maintained, but nobody lives there. Airports are running into losses for many years. The rapid rail networks haven't broke even yet. So are several steel makers, aluminum makers, and zinc smelters. There's no doubt there is excess capacity in China in many industries. Or put differently, the capacities are too big for present consumption, or their usage is too low for them to be profitable at this stage. But despite such an explosive growth that we have seen in China, China is still a developing country. It's not a developed country. It lags advanced economies in several yardsticks: per capita income, per capita consumption of metals, roads, railways. Infrastructure development has remained too focused near the port cities or near the urban China. The rural China has been left far behind. This is why OECD reports, which has been recently published, highlights that China has long-term growth potential quite intact. This makes me conclude that although China moved too fast in creating infrastructure and thus creating demand for metals, all is not over. Yet, this rapid pace of growth of last decade created several imbalances, which will take several years to even out. Over the last 10 years, China has been building base metal smelting, refining, and mining capacity. So it was not only about the demand they created, nearly 90% of the world, but also about the supplies they have been building, which was again 90% of the world. This supply pipeline is still very, very strong. And this is creating a big imbalance, which is making the base metal prices to underperform many other risky assets. Now, a very natural question that comes up here is that when the base metal prices are flirting with marginal cost of production in many cases, like for example, in case of aluminum, nearly 60% of world's aluminum capacities are making cash losses at current prices. And the same applies for zinc and many other base metals. So why these capacities continue to produce even today? China, which is the biggest supplier of the world, why don't they shut down their capacities in order to normalize and bring an equilibrium? I think the world has been waiting for that to happen for many years. It's not happening. And there are reasons why it may not happen for a very, very long time. In our analysis, we can cite two reasons. One, a good part of Chinese base metal industry is in public sector, where social objectives are as important as economic objectives. Many such companies may continue to make cash losses and get government support to survive. You may argue that this is unfair to the rest of the world. You're right, but if Americans and Europeans can go to any extent to save their banks, Chinese support to their industry should not come as a surprise. The second thing is, the Chinese duty structure last 1 decade has been set up to encourage imports of primary metals and discourage exports of metals. Now that the equation is changing in the country, they may allow a window wherein the metals can move out of the country and serve the rest of the world. They did that in copper last year, and it had a big ramifications. China, after that change in the duty structure, opened a window of exporting copper for the first time in the recent history. I don't see a reason why this can't happen for other metals. The last point of my big picture is something that compares China to India, and something that has been discussed in this forum earlier on as well. Chinese working age population contracted by 0.6% last year. First time in 20 years. According to UN projections, this could continue. And we could, as we talk to the market, we could see the real impact of it on ground. A good number of Chinese migrant workers have not returned to cities after their holidays in February because they're getting job opportunities in the countryside near their home. There is no reason for them to go back. Despite the slowdown, it's very difficult to find skilled labor. Now, this is the reason, unlike India, where working age population may continue till 2050, China has least compulsion to revert to high rate of growth and create new jobs. This brings the focus to India as the next driver for metal demand. Believers in the multi-decade commodity supercycle had the same thought, that demand for metals from India could start offsetting when Chinese demand growth starts to fade. This may eventually happen, and I agree, but may not happen as seamlessly as initially thought. India consumes not even 4% of the global metal production compared to 45% by China. We have miles to go to attain a critical mass and thus get world's attention to our favor. To summarize, for nearly a decade it was demand that drove metal prices. For many years to come, it will be supplies that we'll be looking at. My last point on 2013 price outlook, I have 4 themes. Firstly, for those tracking base metal prices on a light mood, it's time for sainthood. One should not get too excited by high prices. One should not get too pessimistic at the fall. Prices will keep bouncing off the floor in a few waves during the year. Dips will be used by consumers for restocking, which have very low inventory levels. Rallies will be sold into by producers. My second theme is that despite most reports suggesting that all base metals will be in surplus in 2013, on the contrary, physical metal supplies will remain very, very tight. Thanks to warehousing queues, financing deals, and a few strong hands which have metals by their side. Premiums will stay high. Copper's premium could rise in the second half. Thirdly, capacity rationalization will hog the limelight, especially in aluminum, zinc, and nickel. High-cost plants all around the world will be idled, and this will provide a floor to prices and harden premium. And my last theme is, if I'm not pessimistic enough, just an optimistic note that we should keep an eye on US recovery, especially its housing sector and the construction sector. Not long ago, all those people who have been tracking base metal market for long, it was the US housing data which was tracked very, very closely to get clues about the metal prices. Housing starts have improved to an annualized pace of 1 million units, which is 40% better than what it was 2 years ago. So if this pace is maintained, a good part of copper's surplus, which analysts have been panning in their reports, could be consumed by US alone. US could be a dark horse. Lastly, there is no doubt that base metal industry is going through a down cycle. It's painful time. It's painful time for the whole industry, for the full chain, because the margins are coming under pressure. At such times, even small price volatility could wipe away operating margins. Hence, a well-thought-out risk management system is more important now than any time ever. Today, when looking outside the window doesn't excite us, this is the time we should be looking inside to install or strengthen the risk management systems. Thank you, everyone.
Thanks, Sandeep. One thing is sure that, going times, markets are going to be volatile. And if you want to secure yourself from the profitability in the business, you require to have a proper risk management framework in place. With this, I would like to end the session today. And I would like everybody to put up applause to all the panelists who have contributed and given good insights about the commodity markets. Thank you.
Once again, thank you very much to all our panelists. I would request Mr. Anup Gupta to present the mementos to our panelists. Yeah, and I would request the guests to, you can take your tea, coffee, and you can sit, and at the same time we can start our sessions also, please. I would request Mr. Anup Gupta to present a memento to our keynote speaker, Mr. Ramesh Abhishek, Chairman, FMC. To our moderator, Mr. Sumesh Parasrampuria, Director, MCX. Our panelist, Mr. Somnath Chatterjee. To Mr. T.S. Kalyanaraman. To Mr. Savas Manosus. Mr. Sandeep Daga. Aditya. Thank you very much. Thank you. Thank you.